Hi, I'm Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And thank you so much for all the questions. As you know, I do a Q&A podcast every second week. So keep them coming. Send them to me, any questions or feedback, to questions@investopoly.com.au. And I actually haven't mentioned it for a while, but there is a discount code for anyone that's interested in buying one of my books. For podcast listeners, you'll see that in the show notes. So the discount code is BLOG, B-L-O-G, of course. And if you follow the link to the website and put that discount code in, it'll only charge you $20, including delivery, for one of my books. So in case that's of any interest. Okay, so let's get into today's episode then. And it's around 4 things that you can do before you even contemplate meeting with a financial advisor. And this came out of a podcast I listened to by James Kirby, where he interviewed a financial advisor. As you know, I've been hosting, or you might be aware, I've been hosting the Australians Money Puzzle podcast for the last couple of weeks while James has been on leave. Anyway, that's why I've been listening to the podcast a little bit to get a feel for it. Anyway, that talked about, how there's a shortage of financial advisors in Australia. In fact, 5 years ago, there was about 30,000 financial advisors. There's only about 15,000 financial advisors. And look, to be honest, it's good that some of those advisors have left the industry, but the fact that the industry is not growing, we're not attracting any new advisors, is a challenge. And as a result, a lot of financial advisors, including our firm, only deal with clients on an ongoing basis. It's just too hard otherwise to resource up for, once-off or occasional advice. You need to have a bit of scale in order to do that. And also they talked about how financial advice fees, ongoing fees, start at around $5,000 a year and are upwards from there. So you've really got to have enough scope and complexity to be able to warrant financial advice or paying for financial advice. And I sort of talked about this a little bit in August in episode 319, where I talked about, how to work out whether, the value of financial advice and whether it's worthwhile for your situation. Anyway, the overarching trend is that more people need to find the solutions for themselves because they can't afford to get financial advice and it's not efficient for them to do so. And so out of that discussion, they were talking about, what are some of the things that you can do before you would go and see a financial advisor. And that's why I wanted to do today's episode, to sort of share my thoughts regarding that. They didn't really stipulate what are the things that someone should do, and I thought I could extend on that discussion and share that with you today. So the first one is know what you're spending, have a solid understanding of your cash flow. Sometimes or quite often we'll get approached by prospective clients interested in engaging in advice, but they really don't know what they're spending, how much surplus income that they have. And if they don't know it, how do we know if we can add value? Because if it's zero or they're going backwards, that's a pretty difficult thing to do. Occasionally clients will come to us, or prospective clients I should say, will come to us seeking help with cash flow management. But my view is that's not only sort of misguided, it's also unnecessary. Managing cash flow is ultimately your responsibility, and an advisor can certainly help you by suggesting certain systems or approaches in order to improve your cash flow management. But hiring a financial advisor to solve that problem for you is not only inefficient, it's too expensive, but it's also like thinking seeing a dietitian won't help you with your diet. It's the work is up to you. It's the discipline of what you're eating and what you're not eating, of course. And so I wouldn't go and pay a financial advisor $5,000 a year just to sort out my cash flow. I'd try and sort out my cash flow before I get to the financial advisor, because there's an abundance of free information available to you, tools and apps on the internet, and, even a lot of the bank's apps, I know Westpac does it, and also ANZ. They help you track and categorize the expenses. So there's a lot of answers out there that you can implement yourself. And that's something that I would certainly sort out before I even contemplated speaking to a financial advisor. And I've mentioned in this podcast 2 really effective ways of managing your cash flow. And I've got links in the blog on the website for further information regarding these. But the first one is, each month categorizing your expenses into certain categories. And you only really want to measure the categories that you're most likely to overspend on. So for example, what my wife and I manage is, how much I spend on wine. That's my sort of one pleasure in life, is collecting, buying, and also drinking wine. Eating out, we do a lot of eating out, so we want to measure that category as well, because we could easily overspend in that category. So you just need to work out what are the, 4 or 5 perhaps categories where you're most likely to overspend, and the rest of the money then can be either allocated into discretionary or non-discretionary. Non-discretionary is what it is. You can't really overspend on that, and insurance premiums and so forth, you will contemplate them. And then discretionary expenditure, which is the leftover stuff. If you've already excluded or separately accounted for the categories that you're most likely to overspend on, then you just need to look at that category overall. So that's one way to do it, but that's quite manual. You've got to do that each month. Doesn't suit everyone. I've been doing it for years, but it depends on your personality and nature and time and so forth. The second strategy is to separate discretionary and non-discretionary spending into 2 separate bank accounts. And really the one we're worried about is the discretionary spending, and then just transfer a set amount, maybe $10,000 a month across into that discretionary, or maybe that's too much, I don't know, a number into that discretionary spending account, and everything that's discretionary, other than sort of utilities and bills and these sorts of things, which are non-discretionary, get paid out of that account. And they've been very successful strategies, by the way. So I would say that there hasn't been really many examples, possibly 1 or 2 over the years, that it hasn't worked on in terms of helping clients manage cash flow. So before you engage an advisor, you've got to know, how much income you're earning, what you're spending on, and what your living expenses are, and therefore how much is left over to allocate towards investing. Now, the next bit of advice is educate yourself. And if you're listening to this podcast, you're probably on the right track already here, so well done. But having some financial literacy is really important. I think not only helps you make smarter decisions, avoid making mistakes, boost your confidence, but most importantly, it'll help you with respect to eventually appointing a financial advisor and understanding their advice, and give you some comfort or boundaries to understand whether the advice is sound as well. Of course, you don't need to become a financial expert. There's just a couple of key concepts I think if we could download into everyone's head, they would be miles better off. And I sat down and thought about 6 of these key concepts. And so the first one is superannuation. Maximizing returns and minimizing fees in super is really simple to do because there's so much information. As I said, I write a blog every year about this in end of July, early August, but it has a huge compounding effect on your super balance in terms of making sure you're in the right fund. A lot of people are disengaged with super, but like I said, it doesn't take a lot of time and energy, and it's so simple to sort out. The next concept is borrowing to invest. When it's done carefully and prudently, leveraging debt can be really highly effective in building wealth, especially if you have a low asset base. So, if you are just starting out, then borrowing to invest is probably going to be really worthwhile for you. If you're closer to retirement, you've already accumulated a lot of assets, then it might not be as appropriate in those circumstances. But really understanding the benefit of leverage. With respect to property and shares, people sometimes get bogged down. Which one's better, property or shares? Which one should I invest in? I would encourage you to turn the question into gearing versus no gearing, because if your strategy suggests you should borrow, or your financial position suggests you should borrow, then it's probably property, because property is the best way to go about that. If it's not appropriate to borrow for your circumstances, then you're probably better off investing in shares. The fourth one is sort of investing in shares today is so much easier and low cost than it has ever been in history. Using diversified ETFs allows you to get access to a broad array of investments and sub-asset classes, very low cost, grounded in evidence-based strategies. So really simple. So understanding you don't need to be scared of the share market, just need to broadly understand what is the strategy, how do these ETFs work. There's a lot of information online, including this podcast, and you're able to implement that. Fifth is to understand property and the power of compounding capital growth. And really what you want to do is invest in property that has the fundamentals to drive above average growth over multi-decade periods, not the next 5 years. Multi-decade periods, that's really critical. I see a lot of stuff online that advertises short-term returns, but do those properties have the fundamentals to continue to drive substantial growth over the next 20 to 30 years is a big question. Often not is the answer. And then finally, recognize the benefit of prioritizing investing over spending. So really invest first and spend what's left over, making sure you've got the discipline to allocate a certain amount each sort of month or whatever it might be towards your financial future, and do that consistently year on year for many years. I can't underestimate the benefit of doing that. So there's sort of 6 sort of high-level concepts. You don't have to understand the detail, but if you understand these concepts, it gives you a framework for tackling financial decisions and working out, what your next step might be and so forth. So some financial literacy is really good, and well done listening to this podcast episode. But if you have a spouse that's not that engaged, encouraging them to get their financial literacy up. And of course, if you've got children, talking to them about that as well. I talk to my kids and they completely zone out. So it doesn't always work. Now, the third thing you want to think about before going and seeing a financial planner is, what is the next move that you need to make financially obvious to you? Do you have a high level of confidence that, look, I think I should invest in property, or I think I shouldn't be borrowing anymore, and I therefore should turn my attention to the share market, or I should be focusing on debt reduction, or whatever it might be. It's good to think about this, right? So obviously there's a lot of value in developing a long-term strategic plan, because it does give you a clear framework for making today's financial decisions. So that is, you can work out, well, should I do this, and how's this going to work out? Because what are the short, medium, and longer term consequences? But if I meet a client and I know what they need, or prospective client, I should say, and I know what they should do next, like it's really obvious to me, my view is, why would you pay me to put a financial plan together? Because what I would tell you as a result of after doing all that work won't be any different to what I'm telling you today. Now, that's easy for me because I've got more than a couple of decades of experience, but I still think it's really worthwhile to think about it or to contemplate it before you think about going to a financial advisor. Because if you can work it out yourself, then maybe you don't need strategic advice at this stage. You just need some help with the execution of that step. And so if it's going and buying investment property, for example, you just need an experienced mortgage broker and a trustworthy buyer's agent, and bang, you can implement that strategy and just avoid or delay at least paying for advice fees for a period of time. So, for example, let me give you an example. If I'm at, say, a young couple, this is a common situation. A young couple, they're already in their long-term home, but they've got little wealth outside of the family home, just a little bit of super, not huge balances or something like that. And they've got a bit of surplus cash flow. In that situation, it's a no-brainer. You go and borrow to buy an investment property because they're still decades away from retirement. So they've got a long enough runway to let that compounding capital growth really kick in. And they've got a very low investment asset base. So the first step is really trying to build that asset base as much as possible and leveraging into an asset that delivers most of its return in compounding capital growth is certainly mathematically easily to prove the most efficient way in order to build wealth. So again, in that situation, I've met those people. I would say, look, go and invest in property. This is what I'm thinking in terms of budget. Go and do that and come back in 2 or 3 years when, your cash flow is again good and we're ready to then think about what the next step is. So I've recorded a video and a couple of years ago, and also written a blog about a year ago, I think it was, discussing the general sort of life stages of how people move through their life from a financial planning perspective, in terms of starting out and then transition to retirement and so forth, and the strategies and things that they want to think about at each stage of those lives. So if you haven't seen that, I think probably the video is graphically a bit, I haven't watched it for a few years, so I probably, whenever I look back at my previous work, I never like it. But anyway, maybe the videos, just graphically and verbally explains it better. But I think having a look at that would be really worthwhile in giving you maybe some context for potentially helping you out to work out what is your next move. But as some general observations, I share sort of 3 general observations. If you have minimal assets but a lot of or good cash flow, then borrowing to invest is probably the next best move for you, like very similar to the example that I just gave you. If you don't own your forever home yet, then buying it as soon as possible is always a good idea, just because of the cost is after tax. And if we don't buy it today and we buy it in 5 years' time, we know that it's most likely going to cost us more, and we've got to pay that additional cost from after tax dollars, which is quite costly. And if you've already bought your forever home, you've invested in property and you've got some surplus cash flow, then I'd think about diversifying, investing in shares, whether that's via making additional super contributions and investing in shares in that environment, or investing outside of super, or maybe both, whatever it might be. But they're just some general observations in terms of stages of life. But you can kind of use the principles that I just spoke about in the second point, and then the understanding the life cycle of an investor in this point, and bringing those two together. Try and work out, can I work out, you don't want to make a mistake here, of course, but with a reasonable level of confidence what my next step is, and therefore at least postpone having to pay a financial advisor hefty fees to be able to work it out. Now, of course, if you've got significant investable funds, either through cash flow or lump sum, then you could have multiple opportunities, and therefore it probably is worthwhile getting some strategic advice and not making any mistakes. Okay, and the fourth and final thing you should think about doing before contemplating engaging a financial advisor is just getting your house in order. And look, this is just a general comment, but it could be a couple of different things. It could be getting on top of some debts, whether they're tax obligations or personal loans, credit cards, anything like that, sorting that stuff out first, making sure you've got a good cash buffer. I typically like my clients to have at least 6 months of living expenses in cash savings, just in an offset account or something like that. If you've got some real dud investments, it's a no-brainer. They're really poor quality investments, they're speculative, whatever they might be. Selling them, consolidating super, improving your banking structure, managing cash flow, as I said, better. Anything like that, that low-hanging fruit, I guess, is just clean it up. If you need to do those sorts of things and they're going to take a little bit of time, again, better off to do that under your own steam rather than do it while you're paying a financial advisor an ongoing fee to do that. So hopefully that gives you a little bit of guidance on what are some of the things that you should do once you've exhausted all those opportunities. And if you get to the point where you go, well, I really don't know what my next step should be, certainly it can be very expensive to make a financial mistake. So certainly in those situations, there could be strong merit for you to engage an advisor at that point. But what I was trying to do with this episode is try and help people work it out themselves, get as far as they can under their own steam, and therefore potentially avoid completely needing to get advice, but at least, if not, delaying it as long as possible. Okay, let's get into some listener questions. And the first listener question is from Mark. And I'm not going to read it out because it's a really long one, but allow me to sort of paraphrase. Mark lives in Hobart, obviously in Tassie, and he's bought a few sort of small investment properties. Some he's occupied and then moved out and then bought another one, so forth. He just bought a primary residence that, a future primary residence, a little bit larger in terms of value that he hopes to move into. So he did that last year. And his general question is around Tasmania and I guess specifically Hobart. And he says that he's typically classified as regional, but he feels like it has like a lot of sort of economic fundamentals. And I think the question's really aimed at, should he, now that he owns a bunch of properties, I think 3 or 4 properties, should he be diversifying away from a market that, has performed okay of recent years and that he's familiar with from a future returns perspective? And also price point, price point is lower there. And he mentioned that, he can do a bit of maintenance too if they're local properties. So I think it's really important to separate the emotional considerations and the practical ones. The emotional considerations can sometimes be, I don't want to invest outside my domicile state because I don't know it. I don't know it as well. The maintenance thing can be one as well. Look, at least if it's down the road or, in the same city, something needs to be done. I've got the option to do it myself. And the way I look at investing is that your aim is to maximize returns with the lowest sort of time input. You don't want to create another job for yourself, of course. Something that's very low touch that delivers good compounding returns over a long period of time is exactly what you need in order to build personal wealth. I'd reframe the question in terms of I'm uncomfortable because I don't know, investing in Melbourne or Brisbane or Perth, whatever it might be. I don't know those locations. Why don't you reframe the question and say, if I wanted to invest in those, who do I know that can help me that knows those markets very well that I trust? So, can I find a buyer's agent or can I get a referral to a buyer's agent from someone I trust? And therefore, you deal with that asset selection issue straight away. It's not a compounding issue. Once you bought the property, you've bought the property. But I wouldn't, in order to make the best financial decision, you try and remove as many of those emotional considerations as possible. The reality is Hobart's population is about 250,000 people, 250,000. So that's smaller than the major regional cities in Victoria and New South Wales, being Geelong and Newcastle, of course, substantially smaller. The reality is, supply and demand fundamentals in a city or town with 250,000 people just isn't the same as it is with a large city of 5 million people. Because, of course, as a city grows, it spreads out. And we know we're not so great at building infrastructure in Australia. And so therefore living 30 k's out of the city is completely different in terms of lifestyle to living, say, 5 k's from the CBD in Melbourne. And that's where you're going to get the imbalance of supply and demand and the imbalance of growth in the long term, because you've got these people that can afford to live close to the city and there's so much more amenity and lifestyle benefits of doing so. And so they're prepared to pay the premium. Whereas I don't know Hobart very well, to be honest, but I would imagine if I live 5 k's from Hobart, or 10 k's from Hobart, the lifestyle's probably not going to change that much. I mean, there's only 250,000 people. And then you've got to think about who is coming to that city that can pay more. Well, certainly there might be some retirees moving from the mainland to Hobart and retiring, and they've got a lot of dollars to spend. You don't want to invest in a market that is reliant upon one sort of buyer or one producer of demand. You want that diversified demand. And so one of the benefits of capital cities is that you've got a lot of different industry, a lot of different employers, a lot of people are attracted to it, overseas immigration as well in order to build population growth or add towards population growth. It's very diversified in terms of the aspects of demand. You're just not going to get that in Hobart. So what does all this mean? Well, it means on a median value perspective, if you look at history over very long periods of time, you're going to get 1 to 2% lower in terms of compounding capital growth. So if mainland's doing 7-ish%, Melbourne, Sydney's doing 7% over a long term, you're looking at 5 or 6%. Probably more than 5, but probably less than 6. And so that's going to have a compounding impact from an investor's perspective in terms of capital growth. But I'd argue if you apply asset selection principles, you should be able to beat the median. So in Melbourne and Sydney, Brisbane, the more established capital cities, places that have population of greater than 1 million people, you should be able to get more than 7% if you've invested well and you hold it for long enough. So there's a big disparity between those things. Now, it's hard to tell that to someone that's in Hobart that's experienced above average growth over the last decade, but we've got to realise that it will smooth out. So what's my answer to Mark's question? You've already got quite a bit of property there. I don't think I'd change it. Buying and selling costs and all those sorts of things. I don't think I'd change it. But if you were starting out, if I could talk to you a few years ago, I'd probably try and talk you into investing outside of Hobart, outside of Tasmania, to try and get some geographical diversification. Ultimately, in my view, reduce investment risk. Because if I'm investing in a town that has 250,000 people, the risk of underperformance compared to those blue chip markets is relatively high, I think. I think that's a reasonable expectation. It's going to underperform. So therefore, by having one property outside of that location, at least I'm reducing my investment risk at a portfolio level because I've got one asset in a key market. But I don't think I'd go and sell assets in order to do that. The second part to Mark's question, it's quite long, so I won't read it out again. But as I said, he's bought this forever home that he's going to rent out for a few years and negatively gear it and then eventually move into it. And then Mark's sort of suggesting, well, do we then go and buy another investment property, get some negative gearing benefits back again? Or is it okay to hold on to an asset that isn't perfectly geared, like it's not going to be geared to the level that's going to give you substantial negative gearing benefits? It's all about quality of assets, Mark. Not gearing and not taxation. That's a consequence of investing, not a reason for it. So I wouldn't be chasing gearing benefits, nor would I really put too much weight on the gearing that a particular asset has. So for example, I would much rather hold on to an asset that maybe has no gearing, but is a fantastic investment asset, than sell that and then potentially buy a lesser quality asset with gearing. Of course, gearing magnifies returns, but that's only one element. There's risk and return. We've got to consider both at the same time. And so you want to consider the risk element associated with your strategy, not just focus on returns. And Mark's in his late 30s, so he's got a bit of a runway here in terms of being, if he's highly leveraged, he's got a bit of time for that to sort of pay dividends. But I would just be really careful. Borrowing's a great servant, but a terrible master. And I've recorded an episode on, debt management and understanding property cash flow and understanding how when you get to retirement, to make sure that you've got a conservative level of debt without necessarily needing to sell a property, because you're going to lose a bit then in capital gains tax and selling costs. So you don't want to be too highly leveraged as well. And I don't, you've given me some numbers, but I haven't sat down and really worked through them, Mark, but that would be my other concern as well. And also taking a long-term view, if you've got, he's saying $200,000 to $300,000 of kind of unleveraged equity, well, in 20 to 30 years, if those properties do their thing and they're good quality assets, you're not going to really worry about that relatively small amount of inefficient gearing, if you like. Okay, that was a bit of a complex one today, a bit of a long one. Keep the questions coming. They're really good, as I say. Questions@investopoly.com.au. Until next week, bye for now.